Okay, so now we're back to buying on margin. So remember, buying on margin pretty much just means that you're buying with borrowed money, or at least partially borrowed money. It is not fully borrowed money because we have other minimums that we have to make sure that we're aware of. But what we're going to calculate here is this, what we just talked about in the last video about the maintenance margin requirement. So if we get to a point where you're below that, then there's two things that have to happen. Either you have to add funds to the account, or you have to liquidate the position. So, the example I gave here, they have X corporation, the stock price is $70. The initial margin, which would be the margin in the first place, is 50%. So this means that they spent $70,000 and they purchased 1,000 shares. So they spent $70,000. That just comes from the $70 times the 1,000 times 1,000 shares purchased to show that the stock value, at least when purchased, is $70,000. But because the initial margin is 50%, we can figure out simply by taking 50% of 70,000 how much of that is borrowed and how much of that is actual funds that they have. In this case, that's 50-50. So 35,000 is borrowed and 35,000 is equity, 50% initial margin and 50% equity. The maintenance margin is 40%. So that 40% line is really important because what that means is that if that stock price reaches a point where my maintenance margin return is less than 40%, then it's going to either require more funds or require to be liquidated. So we need to find where that line is, that stock price line is, to know, when is that call going to happen, if it's going to happen, what is the share price at which that might happen. So if the stock price falls to $60 per share, position value minus borrowing plus additional cash. So we have $60,000. That's simply taken go back to this slide, the 1,000 shares times a new share price of $60 per share. So that's my total value of the stock right now. My borrowed equity didn't change at $35,000 because I still borrowed that to purchase it in the first place. Now what does adjust is the equity itself of my funds. So notice that when the stock price moves down, the equity is the only part that's affected by that. The borrowed money stays the same, which is why my percentage changes, right? It was 50-50. Now of the $60,000, I've got 25,000 is equity and 35,000 is borrowed. So the amount of the margin percentage has gone from being 50% to now the borrowed money represents, the equity represents 41%. If that goes down below 40, that's when the margin call would happen. More funds would need to be added. So to figure out what that would look like, we can simply take the borrowed amount, 35,000, and take that divided by 1 minus 0.4, and all we're doing there is just algebra saying, okay, when does my equity become only 60%? I'm sorry, when does the borrow become over 60%? And the answer to that is $58,333. Now you could also state this in a share price instead if you chose to. You could say this is a $58.33 per share for the 1,000 shares. And that's when the margin call would happen. More funds would need to be added. Equity funds would need to be added. So with 1,000 shares, the stock price margin, the call is $58.33. The margin percentage at $58.33 would be 40% exactly. And obviously this is a repeating decimal, so it'd be 0.3333 to get it to be exactly 40. If you put this in Excel or a calculator, you can see that there's obviously the 33 cents there too, but they just round off in this. To restore the initial margin requirement to half equity, you need to put in, we could take half of the 58.33, so 29,167, which means effectively we would have to put in the additional funds, the difference between this 29,167 and this 23.33 in order to not liquidate. So this is just another illustration. So stock price end of the year value is 26,000. The repayment of principal and interest of 10.9, and the investor's return rate in this case would be 51%. If the stock price doesn't change at all, the investor's rate of return is -9, with a 30% decrease is negative 69%. Now what they've done here is they assume that the borrowing rate for that margin is 9%. So when you're borrowing on margin, the problem with borrowing on margin, well, it's not a bad idea. You're using borrowed funds in order to invest, which is great because then you're not using your own money. But it also eats into your returns. So notice that the 30% increase We got a 51% return, but a 30% decrease. We have a 69% decrease. That's due to the interest rate. The interest rate stated in the book, they say they're charging 9% per year for these shares of stock. So you can see that when we add the interest in there, our decreases get exacerbated, and our increases do too. But notice when there's no change at all, I'm still paying. This is without reading the book. If you see this no change one and you see this -9, that's a good way to, since this is end of the year, since it's a full year, that's an easy way to know what the interest rate was. The rate is told to you in the book, but even if it wasn't, if I had a no change line right here and I see it's a -9 and they're buying on margin, then I know that must be the interest rate. And again, making the assumption of it being a full year because interest rates are stated in annual amounts. All right, sale of shares not owned by an investor but borrowed through a broker, called a short sale. The mechanics: borrow stock from the broker. You must post a margin, so you still have to meet those margin requirements. The broker sells the stock and deposits the proceeds, the margin in the margin account, covering or closing out the position. To buy the stock, the broker returns the title to the original party. So effectively, with a short sale, you first sell and then you buy the shares. So short sellers first borrows a share from the broker and then sells it. Later, the investor must purchase the share of the same stock in order to replace the share that was borrowed. This is called covering the position. So when we buy it, when we're borrowing it from them and we're borrowing the share of stock rather than actual cash, we have to resell it back to them in the future. The required initial margin is usually 50%. It's more for lower price stocks. That's usually just to cover the lower price stocks. Same things if you heard the phrases penny stocks or those types of stocks. Those usually carry more risk, so they can oftentimes have a higher than 50% initial margin requirement. And a lot of times you're liable for any of the cash flow. So if there's a dividend declared on that stock, then you're liable to pay that dividend or reduce the value of your stock by that. And the zero tick and uptick rule was eliminated by the SEC in 2007, so I don't think we necessarily need to go over that. So an example of a short sale. We sell 100 shares of stock at $60 per sale. So this means that it's a short sale, which means I don't actually own them yet. The broker owns them. So I'm selling 100 shares that I don't actually own, which sounds strange in the first place. I understand that. But I'm selling 6,000 shares that are owned by someone else, by the broker specifically in this case. So I sell those. $6,000 must be pledged to the broker. That doesn't mean that I'm paying that money necessarily right now, but that I'm basically stating the fact that I do owe that to the broker. At a minimum, we would need to pledge 50% of the margin. It wouldn't be the full 6,000. Generally, it'd be half. Again, that differs broker to broker, differs based on risk involved in the tax or in the security transaction. But just to use a nice flat number, the pledge is oftentimes 50%. So now there's $9,000 in the margin account in total. So the short sale equity equals the total margin minus the market value. So maintenance margin for short sale stock price, if 1675 is 30% market value. So 30% times 6,000 equals 1,800. You have an excess. You have a $1,200 excess on margin at this point. And where'd that $1,200 come from? That's the difference between this pledged margin, the 50%, 3,000, and the 1,800 we just figured out for the 30% market value. There's where the excess $1,200 comes in for the excess margin. So the price for the margin call. When equity hits less than the 30% times market value, the total margin account, the equity equals the total margin account minus the market value. When my total margin account is equals the total margin divided by 1 plus the maintenance margin requirement, that would happen at $6,923. So here they've just done the math. This will show you the formula and they've done the math. Remember that 9,000 came from the 6,000 pledged and the 3,000 for the 50%. So the price for the margin call, we figure out based on this calculation, is $6,923, or a price of $69.23 per share for the 100 shares. If this occurs, equity is $9,000 minus $69.23. The equity as a percentage of market value equals 30%. And when that 30% happens, because that's when the margin call is occurring, that's when the margin call would happen. If we want to initially or restore the initial 50% margin, we would simply have to add $1,384 to that account. which would take our value up to 50% of the margin that's required, that minimum, or that maintenance margin requirement. Or actually, I'm sorry, this is the initial margin requirement, not the maintenance margin requirement. This is the initial margin requirement. Okay, cash flows from purchasing versus short selling. This is an interesting table, but it shows at time 0 and time 1. Time 0 being when the initial transaction occurs, buying or selling, whichever it is, versus when they receive a dividend and share, sell a share. So purchasing of stock, I buy the share, I pay for the initial price, receive dividend and sell share, and the cash flow is the ending price plus the dividend. Whereas if I'm short selling something, I borrow the share and sell it, so my cash flow goes up. So there's a big difference right there, right? My cash flow, if I'm just purchasing it, goes out because I'm buying the actual share of stock. In a short sale, I'm increasing by the initial price for my cash flow. So remember, positives, and notice this note down here, positives are in cash inflows and negatives are cash outflows. So at the end of this, in the short sale, when I repay the dividend and buy the share to replace the original, that's when the ending price and the dividend come out of the cash flow. So we're effectively flipping the cash flows here. So the profit is the initial price minus the ending price plus the dividend, whereas here the profit is the ending price plus dividend minus the initial price. So we're just reversing this. And the easiest way, I think, to think of a short sale on stock when I think about it, even though I know we've gone through some complicated things, is just think about the fact that, think of it like, and buying on margin kind of works in the same way. Think about it like, instead of having the money to buy the share of stock in the first place, I'm borrowing it instead, which means I am increasing liabilities, which means I'm not receiving, I'm receiving cash flows in, like same thing as taking a loan out. If I take a loan out to buy it, then that would be cash flow coming in. And then when I repay the dividend and the initial price, that's cash flow going out. Whereas if I have the asset in the first place, cash flow goes out first, and then and then we receive the dividend and sell the share at the end. Okay. Okay, and then the final slide for chapter 3 talks about the securities market. They're supposed to somewhat self-regulate, but honestly, the SEC also steps in quite a bit. The Sarbanes-Oxley Act of 2002 was a major change. The scandals that happened in the late 90s, early 2000s, like Enron and WorldCom and several others, created a public company accounting oversight board, PCAOB. Although accountants generally call it peekaboo, even though it's PCAOB. It also requires a lot more financial experts to serve on audit committees. It has requirements for what your audit committee is supposed to look like, how your audit committee is supposed to have some separation from the board. It increases different areas, and this is accounting, so I kind of might go on a little too long about this, but it's a big law, and it was a big change, requiring things like rotation of partners, requiring things like more independence. Also separating out what services auditors can do for their clients, making sure there's no bias involved. But you can go look at that more if you choose to, the Sarbanes-Oxley Act of 2002. Insider trading, which you might have heard before. Insider trading is when you act upon inside information, non-public knowledge about a corporation possessed by officers, major owners, etc., with privileged access to information. So if you're a shareholder and you are also a board member, or if you're a major owner and you're a board member, you're a CEO or you're a manager and you're high up, and you have information like financial information or any information, but oftentimes financial information where you know it before the public does, and you act upon that, it is against the law. Because when you sell and buy and sell securities, you should be acting upon the same information that everyone else has. Famously, Martha Stewart got in trouble for this. There's been plenty more other than just her. She's just one of the ones she's one of the most famous ones that got in trouble for it. But effectively what she did was she knew that her financials were getting ready to come out and they weren't as good as what they had anticipated them being. So she sold shares of stock knowing things the public didn't know, and that she knew the shares were going to decrease in value very soon. So she sold with that information that the public did not have, and that is against the law. So you must sell only the given information that is public knowledge. And that is the end of chapter 3.